Ever wondered how the current state of inflation is nibbling away at your hard-earned savings? Today, we dive into this intriguing topic. Inflation is a bit like a stealthy thief in the night, slowly but surely reducing the purchasing power of your money. It's an economic phenomenon where prices for goods and services rise over time, making each dollar you hold less valuable. You might not notice it from day to day, but over time, it can have a significant impact on your financial well-being. Think of it like this. Let's say you've got $100 tucked away. Today, that $100 might buy you a nice dinner for two, but fast forward a few years, and thanks to inflation, that same $100 might barely cover a casual lunch. The money hasn't changed. It's still $100, but what you can buy with it has shrunk. That's inflation at work, eroding the purchasing power of your money. And it's not just about the money you spend. It's also about the money you save. If you're saving for the future, it's essential to understand how inflation can eat away at your savings over time. Let's say you've put aside a tidy sum for your retirement. But by the time you get to use it, the cost of living has risen so much that your savings don't stretch as far as you'd hoped. That's the power of inflation, and it's why understanding this concept is so crucial for managing your personal finances. To put it simply, if you're not making investments that keep up with or outpace inflation, you're effectively losing money. It's a bit like trying to fill a leaky bucket. The water level might seem fine now, but over time, those leaks will drain away your resources. So inflation can be a real villain when it comes to preserving your wealth. But what if there's a hero waiting in the wings? Enter Bitcoin, the digital currency that's been making waves in the financial world. Could Bitcoin be the hero we need to combat inflation? Let's first delve into the concept of Bitcoin. Bitcoin is a type of digital currency, also known as cryptocurrency, that operates independently of a central bank. It was created in 2009 by an unknown person using the alias Satoshi Nakamoto. Transactions are made with no middlemen, which means no banks. What sets Bitcoin apart from traditional currencies is its decentralized nature. There's no central authority that can suddenly decide to print more Bitcoin and devalue it, unlike what central banks do with traditional fiat currencies. This decentralization is achieved through a technology called blockchain, a public ledger containing all transaction data from anyone using Bitcoin. This transparency helps ensure the integrity of Bitcoin transactions. Now let's talk about Bitcoin's supply. There will only ever be 21 million Bitcoins in existence. That's right. The supply is capped. This limited supply is one of the reasons why Bitcoin has been viewed as an inflation hedge. When the supply of something is limited and demand increases, the price tends to rise. Over the past decade, Bitcoin has gained traction as an asset that can potentially provide protection against inflation. This is because, as we've mentioned, its supply is fixed. So, unlike fiat currencies, which can be printed in unlimited quantities by central banks, leading to inflation, Bitcoin is immune to such monetary policies. Furthermore, Bitcoin's value doesn't rely on the stability of any particular economy. It's a truly global asset. This means that even if one economy is experiencing inflation, Bitcoin can retain its value or even increase in value. However, it's important to note that Bitcoin is a highly volatile asset. While it has the potential to offer high returns, it can also lead to significant losses. So, Bitcoin presents an interesting proposition, but how does it stack up against traditional inflation hedges? When it comes to fighting inflation, traditional assets like gold and real estate have long been the go-to options. But how does Bitcoin compare? In the face of inflation, individuals and financial institutions alike have historically turned to assets such as gold, which have a track record of preserving wealth. Gold, being a finite resource, has an inherent value that tends to remain stable over time, making it an effective hedge against the diminishing purchasing power of fiat currencies. Similarly, real estate is another tangible asset that has often been used as a shield against inflation, as property values and rental income tend to increase with inflation. However, the past decade has seen the rise of a new player in the inflation hedging game, Bitcoin. The world's first cryptocurrency has been lauded as digital gold, exhibiting many of the same properties as its physical counterpart: scarcity, fungibility, and divisibility, but with a few added benefits. One of these benefits is liquidity. While selling a piece of real estate or converting gold into cash can be a time-consuming process, Bitcoin transactions can be executed almost instantly, regardless of the size of the trade, making it highly liquid. Another advantage of Bitcoin is its accessibility. Unlike real estate or gold, which can require significant initial capital, Bitcoin can be bought in fractions, allowing even those with modest means to invest. Moreover, Bitcoin, being a digital asset, can be purchased and sold from anywhere in the world, breaking down geographical barriers that can limit access to traditional hedges. But what about volatility? Yes, Bitcoin is known for its price swings, and that might seem counterintuitive for an asset meant to be a store of value. However, it's crucial to consider the long-term trend. Despite its short-term fluctuations, Bitcoin's value has increased exponentially since its inception, outperforming traditional assets. Let's take the year 2017 as an example. While gold saw a respectable 9% increase in value, and the average real estate price increased by 6%, Bitcoin skyrocketed by nearly 1,400%. That's no small difference. And it's not the only time Bitcoin has outperformed traditional hedges. In the aftermath of the 2020 global financial crisis, Bitcoin's recovery outpaced both gold and real estate, underscoring its potential as a hedge against inflation. However, it's not all sunshine and roses. Bitcoin's digital nature makes it vulnerable to cyber threats, and regulatory uncertainties can add an element of risk. Additionally, its relatively short history compared to gold or real estate means we have less data to predict its future performance. It seems Bitcoin can hold its own against traditional hedges, but as with all investments, there are key points to remember. Bitcoin's performance as an inflation hedge is promising, yet it is not without risk. Therefore, it's essential to do your own research, understand your risk tolerance, and if possible, consult with a financial advisor before making any investment decisions. After all, the best hedge against inflation is a well-diversified portfolio. So, we've taken a journey through the world of inflation and explored Bitcoin's potential as a hedge. But what are the key points to remember? First off, inflation, as we've discussed, is that pesky economic phenomenon that erodes the purchasing power of your savings. It's like a thief in the night, slowly but surely nibbling away at your hard-earned money. And this is where the importance of understanding inflation comes in. If you're not careful, your savings could end up losing its value over time. That's where Bitcoin enters the scene. It's a digital asset that's not subject to the whims and caprices of any government or central bank. Because of its decentralized nature and limited supply, only 21 million Bitcoins will ever exist. It has the potential to act as a hedge against inflation. But remember, Bitcoin isn't the only game in town when it comes to hedging against inflation. Traditional hedges like gold and real estate have been around for a long time, and they've proven their worth. But as we've seen, Bitcoin has certain unique advantages over these traditional hedges. For one, Bitcoin is highly portable. You can carry millions of dollars worth of Bitcoin in a small hardware wallet, something you can't do with gold or real estate. Secondly, Bitcoin is divisible. You can buy a fraction of a Bitcoin. Try doing that with a bar of gold or a piece of real estate. But, and this is a big but, Bitcoin is also highly volatile. Its price can swing wildly in a matter of hours. So while it has potential as an inflation hedge, it's not without risks. Always remember to do your own research and never invest more than you can afford to lose. Remember, knowledge is power. The more you understand about inflation and potential hedges, the better equipped you'll be to preserve your wealth. Until next time, keep exploring and stay savvy.